Pinnvalor Group presents Welcome to a deeper exploration of alternative investment funds, or AIFs, celebrated for their ability to offer portfolio diversification and access to niche investment opportunities. Yet, amidst discussions of high returns and cutting-edge strategies, one critical aspect often escapes attention: exit strategies and liquidity risks. For many investors, especially those new to AIFs, the focus often remains on the potential upside without fully understanding how and when they can realize those gains. This is why understanding exit strategies is vital before committing to an AIF. Why exit strategies matter in AIFs. Unlike traditional investment instruments like mutual funds or equities, AIFs often come with longer investment horizons, complex structures, and bespoke objectives. This makes the process of exiting significantly different and more challenging. Lock-in periods and long tenures. AIFs are designed for long-term investments, with typical lock-in periods ranging from 3 to 10 years. Investors must remain committed for the entire tenure, as premature exits are either prohibited or involve significant penalties. Example: a private equity-focused AIF investing in startups might require a 7 to 10 year horizon to allow portfolio companies to mature and generate returns. Lack of secondary market. Unlike mutual funds or listed stocks, AIF units are not traded on secondary markets. This means investors cannot quickly or easily liquidate holdings, leaving them reliant on fund managers to facilitate exits. Timing the market exit. The success of an AIF often depends on the fund manager's ability to time the sale of assets. For instance, selling a real estate project during a downturn could drastically reduce returns. Common missteps by investors. Many investors skim through the private placement memorandum, PPM, without fully understanding the exit strategy or whether it aligns with their financial goals. Investors sometimes commit large portions of their portfolio to AIFs, only to realize later that the lack of liquidity creates financial strain during emergencies. Blind trust in fund managers. While fund managers are seasoned professionals, relying solely on their expertise without understanding the exit plan can lead to unforeseen challenges, such as what happens if the fund manager changes or underperforms. How investors can address liquidity and exit concerns. 1. Assess the exit strategy before investing. Carefully review the PPM for details such as 1. The expected tenure of the fund. 2. The proposed timeline for asset liquidation. 3. Any penalties or restrictions on early withdrawals. 2. Diversify across AIF categories and tenures to balance liquidity needs. Investors can allocate capital to AIFs with staggered maturity timelines or focus on different categories. 1. Category I. Earlier exits as startups achieve funding rounds. 2. Category II. Longer horizons for private equity and real estate. 3. Category III. Often shorter tenure due to trading-focused strategies. 3. Reserve an emergency liquidity buffer. Avoid over-allocating to AIFs. Keep part of your portfolio in liquid assets like mutual funds or bonds to handle unforeseen financial requirements. 4. Seek clarity on secondary market opportunities. Some AIFs explore secondary market transactions where existing investors can sell their units to new investors. While not guaranteed, this option can provide partial liquidity. 5. Evaluate fund manager track records. A fund manager's ability to execute successful exits is critical. Look for 1. Historical exit timelines and strategies. 2. Past challenges faced and how they were resolved. 3. Their reputation in managing investor communications during exits. Case study: liquidity challenges in real estate AIFs. A prominent real estate AIF launched in 2016 promised significant returns by investing in luxury housing projects. However, delays caused by regulatory hurdles and market slowdowns pushed the exit timeline from 7 years to 10 years. Investors relying on these returns for financial commitments faced challenges. Key takeaway: even with the best projections, unforeseen market conditions can impact exits. Investors must prepare for contingencies. Regulatory safeguards for investor protection. The Securities and Exchange Board of India, SEBI, has introduced measures to enhance transparency and accountability in AIF operations, such as mandatory disclosures, detailed periodic reports on asset performance and potential exit timelines. Custodian oversight. For Category 3 AIFs, custodians ensure proper asset management and mitigate risks. Investor grievance mechanisms. AIFs must have mechanisms to address investor concerns, including those related to liquidity and exits. Conclusion. Plan your exit before entering. The allure of high returns and diversification offered by AIFs can sometimes overshadow the critical consideration of liquidity and exit strategies. Understanding the long-term nature of these funds, aligning them with financial goals, and ensuring a robust liquidity plan are vital for success. By addressing these often overlooked concerns, investors can unlock the true potential of AIFs while safeguarding their financial well-being. Remember, in the world of alternative investments, a well-planned exit is as important as a promising entry.